Thanks for clicking. The London and St. Thomas Association of Realtors, LSTAR, has released London's real estate data for the month of June, showing a market that is slowing down. The slowdown comes as mortgage rates shot up in June, with bond yields surging upwards, and investors expecting that the Bank of Canada will be raising rates in July. Fast forward to right now, and it doesn't look like it's going to be getting any better anytime soon, with the bank still widely expected to deliver a 25 basis point rate hike at its announcement next week, bond yields surging to their highest level since 2007, and fixed mortgage rates shooting up over 6% in some cases. And with mortgage rates increasing comes a decrease in buying power, which will no doubt put even more downward pressure on London's real estate market. So what I want to do today is go over London's real estate data for the month of June, take a look at how these higher mortgage rates are affecting affordability, and then go over some tips going into a market that could very well once again be on the correction. The extent to which London's market corrects will largely be dependent on what happens next week at the Bank of Canada's rate announcement, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home, which represents the most popular set of features. The benchmark price was up, though marginally, in June. The benchmark price in May was sitting at $619,800, and that jumped up to $626,200 in June. So that's a $6,400 increase in the benchmark price, an increase, but the smallest increase that we've seen since February of this year. With that said, London saw the first decrease in the average price in 2023. Our average price in May was sitting at $664,300, and that dropped down to $661,129 in June. That's a $3,145 decrease in our average price. Not much of a decrease, but the first decrease that we've seen all year, and a decrease nonetheless. On to the median price. The median price, if you'll remember, that's where half as many homes were sold over that price and half as many were sold under that price. The median price, much like the benchmark price, was up, though marginally. The median price in May was sitting at $625,000, and that bumped up in June to $628,200. So that's a $3,200 increase in the median price of a home in London, which is still an increase, but it's also the smallest increase that we've seen since April. In the sales to list price ratio, the SLPR is showing signs of a slowdown as well. The SLPR, if you'll remember, that measures by how much a home sells over or under asking price. So if a home is listed for $100,000 and sells for $110,000, the SLPR is 110. London's SLPR in May was sitting at 101 and kept at 101 in June. So homes are still selling for 1% over asking. However, this is breaking the trend, as we saw the SLPR for the last 5 months show consistent increases. And this is going to become even more clear when we look at shifting affordability. Last month, when we looked at the benchmark and average price, we saw that for Londoners to buy that average and benchmark price, they had to earn $150,000 and $160,000 respectively to buy the benchmark and the average priced home. But let's fast forward to this month when rates have gone up quite a bit higher. A decent 5-year fixed insured rate is now sitting at 5.24, so borrowers have to qualify at 7.24. Buyers have to earn $155,000 and $165,000 respectively to get that benchmark and average price home in London. Buyers, on average, have to earn about $5,000 more to get the same price home as they did last month. So, affordability has gotten a bit worse since this point in time last month, and if rates continue to go up, expect to see even more downward pressure put on demand in London. Now, this won't happen immediately. There are still a lot of people with pre-approvals that were good for 120 days, pre-approvals that were obtained 2 months ago, which are still around that 4.5% mark. But, and we've seen this before, if rates continue to stay elevated, expect to see even more downward pressure put on London's prices. And if the market is shifting, if these signs of a slowdown continue to persist, and if the Bank of Canada raises rates, I can imagine they will, then I cannot recommend enough putting in a finance condition on any home in London. Similar to the last correction that we saw at this point in time last year, we don't know exactly when the market is going to have an abrupt shift in London. We don't know exactly when appraisals will start coming in light. although I've already seen a few. And as such, you don't want to get stuck signing firm on a property only to find out later that that property isn't worth what you paid, only to find out that it appraises for less than which you paid, and the bank is not going to finance it. As we've talked about so many times before on this channel, the courts have consistently held in the favor of the sellers when a market shifts and buyers are unable to close. And the best way to protect yourself against getting sued, against not being able to close due to the property devaluing, is to include a finance condition. Get your finances 100% approved before waiving conditions. If your realtor doesn't want you to put in a finance condition, if your realtor doesn't want you to protect yourself from getting sued, find yourself a better realtor. With all of that said, as we mentioned, the extent to which the London market continues to correct will be largely dependent on what happens at the rate announcement next week. We'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.